Let's take the point forward in terms of what liquidity infusion has happened into the system. So Devin, we are looking at surplus liquidity coming into the system for the first time by Reserve Bank of India. So do you think markets should now stop complaining? Liquidity aa chuki hai. There is surplus liquidity in the system.
Yeah, so I think first of all, you're perfectly right. Last year, after entire FX intervention and significant currency leakage, the durable liquidity as well as banking liquidity both had turned negative. So we were, if you look across at June to September 2024, post the RBI dividend declaration, I think we were in significant surplus liquidity. From there, we went into a massive deficit liquidity. Again, thanks to all the proactive measures which RBI has taken, and to give you some number, RBI collectively put together, including tools using CRR, VRR, OMOs, as well as this entire buy swap facility on FX, must have infused close to now 8 lakh crores of liquidity, and including the announcement which they have done yesterday on OMOs. So this kind of liquidity, if you've seen, they've just done infused in COVID kind of environment. So this liquidity injection is very, very positive. And you're perfectly right. I think near-term liquidity problems get sorted out. In fact, our assessment is that from here till September, you will see a positive banking liquidity and a positive durable liquidity to upwards of around 2 to 3 lakh crores. So now the problem will be that probably they will have to start looking at some bit of absorption of liquidity, because liquidity should be in a decent surplus.
If liquidity is surplus, then why is lending not showing up? I mean, the credit growth should have picked up by now because banks said we don't have money. Now they have money, they're not lending. So what difference does it make? What I'm trying to perhaps arrive at, Devang, is when liquidity was not there, banks had a reason not to lend. Now liquidity is surplus, it should start reflected in credit growth, or it should start reflecting in loan growth. Why that is not coming out?
So I would say it is a two-way perspective. I think first is that genuinely there has been a slowdown. So there has been an acknowledgement both by RBI and government that there is a slowdown. Now, credit is a direct multiple of what is the demand scenario. If the demand scenario or the overall growth scenario is weakening, somewhere down the line, credit growth starts to look weaker. So our perspective is there are two things which needs to be addressed. Is the growth cycle. They have been looking at measures, both RBI and government put together. So RBI is looking at monetary easing, financial conditions started getting easier. They are looking at probably rate cuts. They've delivered one rate cut. We believe that April policy, we should see another rate cut. So they are working on propping up the growth cycle. Second aspect is, which you spoke about before, is about this entire balance sheet growth at RBI level. Last year, because of the drop in FX reserves, there was a significant shrinkage in RBI balance sheet, and that was leading to overall deposit growth being lower. And because deposit growth was lower, you couldn't do an onward lending. Our perspective is RBI started working on significantly addressing this entire RBI balance sheet problem. They have infused a lot of liquidity in the near term. I think RBI dividend, once it gets declared, RBI balance sheet growth should be good enough, and we should start seeing the deposit growth to be positive. Once the deposit growth starts looking good, if growth cycle starts picking up, we should start seeing the increased credit cycle also, and the credit growth should start picking up. So that is how we see the near term as well as the next 6 to 12 months perspective on credit deposit.
To ensure this liquidity, RBI has been taking so many steps, and the case in point being the OMO purchase that's been registered to be the highest net OMO purchase activities since in India since FY21. But now that the surplus is in the system, help us understand that how do you foresee RBI's focus shifting, and what could be the next steps to be taken by RBI to ensure growth?
So as I highlighted, I think RBI has been very, very proactive in addressing I think the near-term problems. I somewhere down the line believe that there was a lot of acknowledgement both by RBI, the regulator, as well as government, that economy has started to show some signs of weakness. And how they've tried to address it, because we had limited space on the fiscal side. We have done a superb job of fiscal consolidation over the last 2-3 years. And that is why the monetary impulse was necessary. We started with some bit of relaxation on, so the risk weights which were increased last year for NBFCs, microfinance were I think, reversed and got back to where they were before. Second impact is more from a perspective is getting the financial conditions easier. They have now intervened into the market on all aspects on liquidity side, and somewhere down the line infused close to 7.5 to 8 lakh crores of liquidity using the all tools. Our perspective is the next step would be actual rate cuts. They have already delivered 125 basis of rate cut. We believe that there can be additional 2 rate cuts. My personal view is probably they can do a 25 basis of rate cut in April, then have a pause in the near term, look at the market scenario, what's happening on the global front, how the growth cycle is panning out, and then probably do a 25 basis rate cut in the second half of this year. So the next move should be with rate cuts.
At what point in time rate cut and a liquidity combination will start demand uptick? Because ultimately it comes down to a combination of liquidity, availability, and rate cut, which is affordability, that would kick back in, and corporates would say, okay, it makes sense for us to start borrowing.
So, see, our perspective is that it's also a function of what's happening on the growth cycle, how somewhere down the line the consumption cycle picks up. So they have done, I would say, some rejig in the fiscal math also, whereby they have done some bit of allocation from capex to consumption in the near term to somewhere down the line support the consumption growth cycle. Also, I think generally, if we have seen the past rate cut cycles, the rate cut cycle from an economic theory perspective also works with a 6 to 12-month period, and you start seeing pickup in credit growth, you start seeing pickup in underlying activity and the growth cycle. So our perspective is that the monetary easing currently, as well as the rate cuts which will get delivered in the next quarter or 6 months, should start seeing pickup in activity, should lead to pickup in activity and growth with a 6-month lag. So second half of this year is where we believe that growth cycle should start picking up, unless and until we get some big shocks from the external side.
Devang, also give us a sense that how do you see the Indian bond yields moving, because just today they have been hitting their 3-year low on the back of the RBI OMO purchase, and lots been happening globally as well. So share your perspective on Indian bond yields.
Yeah, so I think bond markets have been quite positive for the last 6 to 9 months. We have actually seen in the last 12 months yields easing by more than 50 to 60 odd basis. Our perspective is bond markets are now pricing in at least a 25 basis of rate cut in the near term, and probably the swap curves are actually pricing in somewhere between 50 to 75 basis of rate cuts. So a large part of the rally is done. Because the demand supply dynamics looks okay in the near term, it's significantly supported with OMO purchases. Secondly, I think we are at the beginning of the rate cut cycle. We should see additional couple of rate cuts. And that is why our perspective is that, yes, you should see another 15 to 25 basis of rally from here on. We are currently trading at around 6.5. Our perspective is that bond markets will trade in a range of around 6.25 to 6.5 in the next 3 to 6 months. Yes, I think just from a perspective of investors, we need to guide them that a rally of around 60-70 basis is already done. Incrementally from here on, you should be looking at around 15 to 25 basis of rally more as per us, because of the rate cuts and the entire positive demand supply dynamics due to OMOs.
Gaurang, with this, we let you go on that. Thank you so much for taking the time out and speaking with us. Really appreciate that.
If you like this video, then like, share and subscribe to ET Now.